All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So if you're a real estate investor and you're researching how to use life insurance for real estate investing, you've come to the right place. Today we're going to be talking about how to get the most cash value in a life insurance policy. And what I want to show you is how to get the most cash value in a policy, what that will do for you. This is important because it comes down to the fundamental question of the double play, which is really, am I better off putting my money into a life insurance policy and then leveraging the cash value to invest in real estate, or just simply taking my money and investing in real estate? And if your policy is designed right, the answer to that question is going to be yes. But if it's not, very likely you would have been better off by putting your money directly into real estate investing. So if you're interested in learning how to put your money to work in two places at one time and making sure that your policy is designed right, stay tuned after the intro and we'll get started. Hi, I'm Tom Rutkowski with Innovative Retirement Strategies. And if you've been watching my videos, you know I'm a bit of a financial nerd. So things like compounding interest and interest rate arbitrage fascinate me. And I discovered the concept of the double play many years ago on my own, and it's so powerful that I wanted to share it with everyone. So the goal of this channel is to give you the tools that you need without ever talking to a life insurance agent to make sure that you get a properly maximum overfunded life insurance policy and you understand how it works. Because the people who are using this, the people that these videos are geared towards, are those who are interested in this subject and want to know all of the details behind it. How does it work? Why does it work? How does life insurance work, right? So again, today we're talking about how to get the most cash value in a life insurance policy. And this is important because, again, it comes down to the fundamental question of the double play, which is, am I better off putting my money into a maximum overfunded life insurance policy to invest in real estate, or just simply take my money and invest in real estate? Now, all life insurance policies have cash value. So you can get a poorly designed policy and you can leverage the cash value. But would that make sense for you? In the absence of the death benefit and the need for the death benefit protection, would that have been better off for you? So that's the question that we're going to be addressing today. All right, so let me take care of a few housekeeping items and then we'll get started. All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. We're going to be taking a pretty deep dive into how life insurance works and policy design. So if you don't have a good grasp of how permanent life insurance works, I've got some great videos for you to take a look at in the description. There's a Life Insurance 101 video. So go ahead and click that, watch it. That should bring you up to speed to get started on this video if you haven't already watched it. While you're down there, be sure to like and subscribe to this channel so that you're notified whenever I come out with new videos. All right, so let's get started. Let's take a look at a normal life insurance policy. Now keep in mind, all permanent life insurance policies have cash value. They all can be leveraged, but will it make sense for the double play? So one of the first things that we need to do to get started is to talk about the differences between a minimally funded life insurance policy and one that's maximum overfunded. So most people, when they think of permanent life insurance policies, are thinking of a minimally funded policy. So all of the myths, all of the misconceptions primarily relate to a minimally funded permanent life insurance policy, where the goal is to get as much cash value as you can for your premium dollars. And by definition, that policy is going to have the least amount of cash value necessary to perform on the commitments of or obligations of that policy. So if you think about it, if you were to call up an agent and ask for a quote on $1 million policy, he knows that you're going to be taking a look at other companies. So he's going to give you the lowest price possible for that $1 million of coverage. So underneath the hood of that policy, the insurance company knows it's going to have to pay $1 million someday. So some portion of your premium dollars are going to be going towards a savings component, so that if the insured lives to their normal life expectancy, their cash value will accumulate and basically save up the death benefit over the insured's lifetime. By the same token, the insurance company is on the hook for the death benefit at every step along the way. So some extra premium has to be collected to cover that mortality risk. So this is my standard graph of a minimally funded life insurance policy. The orange line at the top shows the $1 million death benefit, and the blue line shows the cash value, and you can see that slowly but surely accumulating over the lifetime of the insured. For the purposes of the double play, certainly a policy like this has cash value, and that cash value could be leveraged, but would you be better off putting your money into a life insurance policy and investing in real estate, or just simply taking your money to invest in real estate? And if most of your premium dollars are going towards fees and expenses, you can see that you're not going to have as much money working for you as you could. So in a properly designed maximum overfunded life insurance policy, the cash value to premium ratio is about 85%, meaning 85 cents of every dollar after all the fees are taken out goes to the cash value of the policy. So last week in the video that I released, I talked about the magic checking account. And this hypothetical magic checking account was the perfect vehicle for the double play because there were no fees. So basically you could write a check against a credit line secured by the cash that you had in your magic checking account. So for every dollar that you had in your magic checking account, you had $1 credit line. So you had $2 going to work for you for every dollar of savings that you have. And that's the perfect situation. But we know life insurance is not the perfect situation. So if 85 cents of every dollar goes to the cash value, every dollar of premium gives you 85 cents of cash value and a credit line for 85 cents. So you've really got about $1.70 that's going to work for you, less the cost of money, the interest expense. Now, in the video that I did last week on the magic checking account, I showed you that even with that 15% loss that you have, because your money's going to work in two places at one time, the double play does work out for you. You're earning a higher rate of return, so that 85 cents will grow and catch up to where it should have been had you just taken the money and invested in real estate directly. But now we need to get back to the issue of what if the policy is not properly designed and you don't have 85% cash value to premium? What if it's 65% cash value to premium, like a lot of overfunded life insurance policies? So what if the policy is not properly designed? What if the cash value to premium ratio is only 65 cents for every dollar of premium? Well, in that case, you're losing 35 cents of every dollar of premium to the fees and expenses of the policy. So you're left with 65 cents of cash value. And just like any permanent life insurance policy, you can get a line of credit against that policy's cash value, and you can use that to invest in real estate. But now the problem is you only have 65 cents of cash value and a line of credit for 65 cents. So you've got really $1.30 that's going to work for you. Now, that $1.30 is going to earn a higher rate of return. But how long is it going to take to catch up to where you should have been or could have been had you just simply taken your money and put it directly into real estate? So that's the main problem that we have with not getting a properly maximum overfunded life insurance policy. Either it's not going to work at all, or it's going to take much longer to get to where you want to be than it would be had you had a properly designed policy. So just so we're clear on the definitions, an overfunded life insurance policy is any life insurance policy that has more cash in it than is absolutely necessary to perform on the obligations of the contract. But a maximum overfunded life insurance policy is one that's designed right up to the statutorily defined limit that still meets the definition of life insurance. An upper limit is defined so that life insurance is still life insurance and not an investment. And if you think about it, if somebody had $100 million and they put it into a $100 million premium on a policy with a $100 million death benefit. Since the death benefit is received by the beneficiary tax-free, you can see how that would be a good way to skirt the estate tax rules, right? So the government, in its wisdom, has defined limits on how much of that premium dollar has to be spent on insurance. And that's how we get these limits. So typically when we design these policies, we've got about 85 cents of every dollar of premium going to the cash value. And typically, an illustration, when you're looking at it, the end of year values are what's shown on that illustration. So typically any dividends, any interest crediting has already been factored into that number. So you may see numbers that are higher than 85%. I'm typically talking about how much cash value is actually available to leverage on day one of that policy. So you've got to back out any growth that was assumed in the illustration. So for example, if there was a 6% dividend, you want to back out that 6% dividend from that end of year number to arrive at that, what I call the 85% number. Now, there are differences between companies. Not every company is going to be able to get their product to that limit. So that's why it's important to work with an agent who does these, so that you work with a company and policies that can get to that legal limit. Because at the end of the day, we're designing the policy such that the death benefit is going to be the lowest possible for the amount of premium that the client is paying. And when you lower the death benefit, you're also lowering the fees and expenses, and the commission is part of those fees and expenses. So to get this, you're basically asking the agent to take his pay compensation and minimize that as much as possible. All right, so now that I've belabored the concept of a maximum overfunded life insurance policy, let's move on to the differences in between indexed universal life and whole life. So let's start with indexed universal life. Running a maximum overfunded indexed universal life is actually very easy. The software solves for the amount of premium that's necessary for any given death benefit. But you can also flip it around the other way so that for any given premium, you can solve for the lowest possible death benefit that you can get for that amount of premium. So the upper limit on the amount of premium that you can put into a policy with any given death benefit is called the guideline level premium. So that defines the limit that meets the definition of life insurance. Anything over that is not life insurance. Anything under that is overfunded, but not maximum overfunded. So if the solve is done right, the policy should end up with about 85 cents of cash value for every dollar of premium that you're putting into the policy. And that should be at the guideline level premium amount. So the only other thing that we need to take into account with an indexed universal life policy is that you want to have or work with a company that has an early cash value rider. And what that early cash value rider does is it eliminates the surrender charges on the policy. So typically, if you give up your policy within the first 10, 15 years of that contract, the insurance company is not going to give you all of your money back. So when you want to borrow against the policy's cash value, the surrender value also limits how much you can borrow against the cash value that's actually in the policy. Because otherwise, if they let you borrow against all the cash value and you walked away from that loan, you're defeating the whole purpose of the surrender charges. So without the early cash value rider on the policy, there's no way to access all of the cash value that's available. And that brings us back to the fundamental question of the double play, which is, am I better off putting my money into life insurance and leveraging it to invest in real estate, or just simply investing in real estate? So again, if you don't have access to 100% of the cash value that's in that policy, the double play may not work out for you. And I highly recommend going back and watching the 3 key success factors for the double play, which is a great video which goes over the policy design and other factors that are important when you're picking a policy to use for the double play. And there's a link in the description, and the card for that should be on screen right now. All right, so let's move on to whole life policy designs. Whole life is an entirely different story. It's much more difficult to design a maximum overfunded whole life. There's a lot more moving parts that go into it, and frankly, it's more of a work of art than it is a science. You know, on an indexed universal life, or any universal life for that matter, it's really just as easy as putting the premium into the software and telling it to solve based on guideline premium. With whole life, different insurance companies have different products. So your typical base policy or your typical whole life is a minimally funded life insurance policy, meaning it's set up to collect a minimum amount of premium necessary to provide that death benefit protection. So that by itself doesn't get us what we want. But what we can do is bundle in a term rider with that base policy, which allows us to bring the death benefit up much higher. And once we've got a higher death benefit, then by statute, we're allowed to put more premium into it. Well, that premium is put into it in the form of paid up additions. So a maximum overfunded whole life is a combination of as small a base policy as possible, the term rider, and then the paid up additions. Now, different companies have different names for this. Plus, they've created other hybrids of term and paid up additions. So the names that I'm using here are more fundamental, but it may not be what you see across every single product. And the other thing to keep in mind with whole life is the premium schedule that the client wishes to pay. So a lot of my cases where somebody has a fixed amount of savings and they want to get that savings into life insurance, typically I always say that a 5-year funding is the most optimal way to get your money into a life insurance policy and keep the death benefit and fees to an absolute minimum while still getting your money into the policy and working as quickly as possible. But if somebody is starting from scratch and they just want to start saving money in the high cash value life insurance policy, well, then you got to start somewhere. So you're going to be paying typically for life, or in most cases, I do use a pay to age 65 type chassis. But insurance companies have different products. They've got products that you can pay for life. They've got products where you can pay to age 65. They've got products where you can pay for 10 or even 20 years. And with those shorter products that don't go for life, typically the goal is to overfund it just enough to get it to be paid up at the 10-year mark, at the 20-year mark, at age 65. And when I say paid up, what I mean is at that point in time, you've reached the minimum corridor where you've got the most cash value, but the least amount of death benefit. The cash value represents the present value of the future death benefit. So you've got as little life insurance death benefit protection in there as possible. The bottom line is the agent needs to know how to bundle these products and the different components of the products together in such a way as to get the cash value as close to that MEC limit as you possibly can, which without going over. And again, one of the keys here is if you're going to be using your policy for real estate investing, you don't want to leave room for more paid up additions to be added to the policy later, which is what's typically done in a policy designed for be your own bank or infinite banking. You want that policy to be overfunded from the beginning so that you've got the most money that you can put to work in 2 places at one time as possible. Anything less than that, again, you're getting back to a policy where you might have been better off putting your money directly into real estate if you didn't need the death benefit of the life insurance policy. All right, so wrapping up, let's just face it, life insurance is not the perfect vehicle for the double play. If we could get back to it, the last week's video on the magic checking account was the most efficient vehicle, but it's a hypothetical construct. So in the real world, a maximum overfunded life insurance policy is about as close as we can get to that perfect vehicle for the double play. Mind you can do the double play with real estate. You can take out a home equity line of credit, but typically that's going to be at a 60, 70, 80% loan to value. So you're not getting access to all of the value of your home. You can also get a line of credit against a portfolio of securities. But again, you're not going to get access to that entire value of your portfolio because the lender knows that the value of those securities in there could go down. But life insurance is that great vehicle where they're required by statute in all 50 states to make loans to their policy owners secured by the cash value of those policies. So typically you can access nearly 100% of your cash value via a policy loan. And it's the ability to put all of that money to work in 2 places at one time that makes this such an efficient vehicle for the double play. for putting your money to work in two places at one time. So as a general guideline, just remember that in a properly designed maximum overfunded policy, the ratio of cash value to premium should be about 85%. And you should be taking that end of year value on your illustration and backing out the first year's worth of growth to arrive at that 85% number. Because sometimes you'll see a number that looks like 90%, but you've really got to back out that growth to arrive at how much cash is really there before that dividend is paid. So it's important to understand that those fees represent your handicap. You know, if you've got a 15% charge or load, like I've shown in a properly designed maximum overfunded policy, you can put your money to work in two places at one time and earn a higher rate of return, which will make up for that 15% loss that you've got and put you back on track to where you could have been had you put your money directly into whatever it is you're investing in. But when you're starting off with a much bigger handicap, like say 35%, it takes much, much longer to catch up to where you should have been if you will ever do it in a reasonable amount of time. So it's important to always keep in mind the fundamental question of the double play, which is, am I better off by putting my money into a maximum overfunded life insurance policy to invest in real estate, or just simply taking my money and investing in real estate? And if your policy is designed properly, the answer to that question should be yes. That's all I have for you this week. If you're interested in continuing to learn about this subject, I recommend taking a look at the 3 key success factors for the double play. And if much of what I said was over your head, I recommend going and taking a look at the Life Insurance 101 video. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend going out to Facebook and looking for the Double Play group. And I'll put a link to it in the description down below. But the Double Play group is a users group of my clients, other people who are using cash value life insurance for investing in real estate, as well as people who are interested in learning about the double play. So if you're interested, go there and post questions to the group. Otherwise, I'd highly recommend going out to my website. I consider my website to be a no-fluff zone, so I've got tons of information on maximum overfunded life insurance policies, everything you need to know to understand permanent life insurance, and then technical papers that you can download on the double play itself with business models and numbers that you can actually analyze. So with that, I'd like to thank you for attending, and I'll see you in a few weeks.